What's going on, everybody, and welcome to another episode of the Market Misfits podcast. I'm your host, Joe Shiva, joined again by my partner in crime, Smiddy. Smiddy, how are you, brother?
Doing fantastic. How you doing today?
And I'm doing great. And we are joined by special guest, Ronchero Friedman. Ron, welcome back to the podcast.
Thank you. Thank you for having me, Joe.
Of course. Today is January 12th, recording right at the close. I always forget to do that. Sometimes it's relevant, sometimes it's not. Today, we are going to talk about a couple things. So one, we kind of had a bombshell get dropped last night from the Fed Reserve Twitter and of Jerome Powell talking about his indictment from the DOJ, which was interesting and not something that I think anybody had on their bingo card for this week. And then we wanted to talk a little bit about 2026, the outlook from some of the Wall Street analysts and, kind of giving our thoughts and opinions on it. But before we do that, let's talk about our boy Jay Powell. So some context for those that are probably not aware if you live under a rock. But basically, Jerome Powell came out yesterday and said he was issued grand jury subpoenas, and they are threatening criminal indictment from his actions with regarding to the June 2025 Senate banking testimony, and the $2.5 billion renovation, I believe it's $2.5 billion, headquarters renovation in Washington, D.C. Basically, the probe centers on whether Powell's testimony about the renovation was false or misleading in the context of like cost, and allegations that the project included luxury style features was what one of the articles wrote. And then from this, Powell, who did something he normally never does because he loves to stay out of the limelight, in all honesty, came out and went public on the Fed Reserve Twitter in a video and called this move unprecedented and argued that the renovation costs are being used as a pretext to pressure the Fed and undermined central bank independence. And he basically said that the reason this is happening is because Trump wants me to cut rates. And because I'm not cutting rates, he's coming after me. Very interesting. The reason why this really matters, and quite my takeaway from this, and then I'll let you guys kind of jump into it, is this is kind of a credibility headline, in my opinion. And whether or not the Fed can set policy without like political or legal intimidation, and how the president functions inside of that. The Federal Reserve has always been an independent thing and that makes decisions on monetary policy in their own way. So that could definitely inject some uncertainty in the markets. You wouldn't have saw it today because they bid it right back up from the dip in the overnight. But no, I'm curious, Smid. I know you were getting pretty hot this morning on some of this. So why don't you kick us off on what you think?
Yeah, I mean, it's a little of that frustration was broad picture. I think over the weekend we have a lot unfolding, right? The Greenland, we've got the Jerome Powell, obviously late last night. Everything that's happening up in Minnesota, which I think is just creating a lot of division amongst the people and that's tough. Yeah. From the financial side, I think it's completely insane what the move that Trump is making. And it is just it's pressure. It's, hey, I want this. You're not doing it. I'm going to do what I can. I'm going to use the tools at hand to kind of force you into a corner. It's a very weird timing because Jerome Powell's pretty much done. 95% odds look like for hold in January.
In May.
Right. And then a 25% chance cut in March. We've got some data in between, right? CPI is tomorrow, correct? Correct me if I'm wrong. But yeah, I think it's a really odd move given, given where we are at in the political cycle too, with Trump doing a lot of things that seem questionable on the legal front, and he's kind of shooting now and asking questions and lawyers later. So that's what I see more of. To me, it feels, it feels a little disingenuous that he would do that to the public markets. Right. That's something to me that is, it seems like it was an effort to really destabilize things and it didn't really work. So it's foolish, but that's my take on it.
Ron, what do you think?
I think it's theater.
Ooh, got a different take. So explain it. Explain it.
I mean, I think it's the reason I say that is I feel like Jay Powell felt compelled enough to defend himself, which I don't have a problem with. Like, I don't think I'm in disagreement with either one of you that I don't think he is a bad guy. I don't think he's running a personal agenda. I don't think he has a political agenda. I think he is focused on trying to make the best decisions that he can for how the economy is running and runs. I mean, no, if you think about it, first of all, if you have that job, you need thick skin. If you have that job, you're dedicated to that institution and that process. You're not there to rip it off. You're not there to rip off the American people or its economic system. You're part of a bigger picture. And I think it takes an individual with a certain moral fiber and character to actually be in that job. So for a standing president to go after the chairman of the Fed, I think is a little bit dramatic. I mean, we're getting to a point to where he's not going to be there anymore anyway. So
right.
Why does he need, like, let me ask you a question. Since he's been there, if you put money in the S&P 500, if you were a long-term investor, how have you done?
Really, really good. Really well.
So what's the problem? And you know, I get it that there's a ton of tensions internally in our country, and division and gap between wealthy, middle class, and poor has grown to a level where internally, politically, our country is very touchy right now, extremely touchy. I don't think that that's related to the Fed. And I don't think that there's an agenda from him. I think that you're blind if you don't see that disparity. And I think you see a government that's wrestling with it. And what is a quarter point going to do for somebody who is on the wrong end of the gap in haves and have-nots? Is it really going to impact them? Those are the people who probably need the most help. So to go after Jay Powell blaming the Fed for that particular issue, I don't think is helpful. And as far as like the remodeling of the space, et cetera, like that's not his job. He didn't I don't think he sat back on vacation and was like, let's remodel this motherfucker. Let's find a way to spend $2.5 billion remodel it. Why? He's not even gonna be there to enjoy it when it's done.
Yeah, he's gonna be gone.
He doesn't care. That's not what he does. So I think it's theater. It's no mystery that the current president has an issue with how Jay Powell does his job. So just let the man finish what he's doing.
Yeah. I didn't understand the timing. The timing of it is the part that just didn't make any sense to me, as you kind of pointed out. Like, the guy's gone in May, not coming back.
Right.
I mean, if you think that this is going to put pressure on him to cut rates prematurely when he doesn't think we should, you're mistaken. Because if anything, I think this just opens up the game and makes it even worse, the cat and mouse, or the game of chicken that they've been playing already. We've seen that, right? Trump comes out every time, too late, Powell. And Trump's of the opinion that we just need to cut rates aggressively. And then if it goes against us, we'll just hike them back up. And he wants to play this kind of like a rubber band, which has plenty of its own implications in and of itself. I thought it was interesting that a lot of the previous Fed Reserve chairmen all came together behind and backed Powell. They wrote a little statement and signed it from what I had seen on social media, which I thought was cool, like Bernanke and all of them. So, obviously they're backing him. I just, to your point, Ron, just feels like a political posturing from Trump that doesn't make a whole lot of sense. or maybe he's trying to set this up for whoever the next person is. Like, you need to be on board with what I ask of you, which honestly is what sets the scary precedent.
I know.
More than anything else.
What their function is supposed to be.
Right. They're not supposed to be a function or an arm or an extension of the president and how he feels about the economy. It's independent for a reason.
Independent.
Right. So, I think, overall, the way that I'm kind of looking at this, at least if I put on my trader, cap, is the timing of it is what I find, I think, the most shocking, but also the most interesting if you put on your tinfoil cap a little bit with me here. As we're putting, right? Put the tinfoil on. Get the tinfoil. If we're pulling into like this, we've talked about liquidity and the issues with liquidity on different fronts, right? Jay has mentioned that a bunch of different times. You look at the markets where we stand now, the rate cuts aren't really being priced in. Like, we're already priced out pretty much for January. March is, got a little bit more, which I think that'll eventually be priced out anyway. I don't think Powell's going to cut it all until he's out, but there's an argument that could be made that this now drives headline risk for any little thing that comes out of this between Powell, because we saw it in the futures market, even though they bought it back up. And maybe if it becomes big enough with any particular issues or problems, I'm not saying which direction we go, up or down, there's the potential that this could, overtake poor economic data if that's what's coming out. Because we don't know. But it would be interesting. They do this all the time. At least what I've noticed in the last couple of years is when you get bad economic data or something else, not just econ data, just in general. If there's like headlines you're trying to bury, something else comes out that trumps, for the lack of a better term, everything else. And now everyone only cares about that. Like, if you look at Trump with tariffs, it didn't even matter what the economic data was. All it cared was what he's going to do with tariffs, and off we went. And the same thing could be said for non-trading stuff, where you get a poor headline about. We won't get into the whole politics of everything up in Minnesota, but there's headlines that are going on that are pulling away the mainstream audience. I'm not saying that that's what this is, and like that's why he's doing it now, but it's just a weird, like, I can't justify the timing of it because it doesn't matter. If the guy's leaving, one, why would he want lavish anything in a building that was built in the 1930s?
Yeah.
Like, he even said, I'm not putting a garden terrace up there. He's not going to have a golden plated toilet, right? Like, none of that is the case. So it just doesn't make sense. Like, and you think Powell, the guy, looks so frugal in and of itself. I don't know him personally. But you really think this guy is the one that wants lavish shit? Come on. Like,
I don't.
The guy who putzes around fish concerts. I don't know that he's necessarily concerned about luxury and lavish.
Yeah, so I'm with you, Ron. This looks like theater. I think the timing is interesting, just because it doesn't make sense. Maybe there's something coming out that they're trying to bury, and they're going to use this for headline risk. I have no idea. That's tinfoil hat.
Well, I like tinfoil hat though, because it's fun to talk about. Whether it's we're not trying to make like predictions or say, no, this is exactly what's happening and we know, like, that's just all conspiracy craziness, right? But it is fun to talk about, and it is fun to link things like, well, right before all this stuff blew up within our own borders, we were right on the doorstep of the Epstein thing, and then all of this other shit blew up, right? They went and snatched Venezuela guy. They are encouraging potential revolution in Iran. They freaking snatched a Russian oil tanker on the run. You know what I mean? Like, there's all these other distractions going on. And what blows me away with all of these things that are happening is our markets they don't even see it happening. It's like the dumpster fire in the backyard. And they're like, yeah, we're just going to keep buying. We're going higher. It's to me, it's unusual. I haven't seen that combination of things happen together and markets not react negatively, at least for like a day or days or a week. It's unusual to me.
Yeah, and then today is an interesting day too, because even though they bought the gap, like VVIX stayed elevated. So, there's a lot of stuff coming out this week.
To me too.
Yeah, VVIX staying elevated. I mean, again, you also got the Supreme Court decision coming out. Like, that's why the timing of this is just so crazy. Like, you're looking at all the geopolitical stuff, right? You're talking about the Supreme Court stuff on tariffs coming out allegedly on Wednesday. It's just so wild. Like, the news cycle is kind of chaotic right now, and the markets aren't even budging. They don't give a shit.
And that sorry, Joe, go ahead. Finish your thought.
No. I'm just saying, like, if you look at the VIX and like the VVIX and all the VVIX elevated, if you look at VIX, there's not been any demand at all for like crazy left tail protection during all of this. Like nobody, it seems like nobody cares.
And
right?
where's the volume?
Right.
The volume was supposed to be back. Where is it?
Yeah, it has not. It's gotten better since the Christmas time, but it's not. But it's not. It's not up there with expectation of what we want. Like today, especially, was just the underlying event Q futures. They were kind of selling while we kept going. ES had a constant bid. Yeah, and just nobody gave a shit. Like it just. So, I welcome some volatility. I kind of got used to it. I hope that this brings some into it. But anyways, to kind of finish, with the J Powell stuff is. I am just more worried that this now spills over in May when he elects the new Fed chair, and now there is a direct line to the Fed and he is definitely a person that is manipulated by what the president has to say. Because again, love him or hate him, I don't need to get on anybody's political affiliations. I think it's a very sticky. And I would actually come out against the president of any president having any say in monetary policy from the Fed Reserve. I think it's too much of a slippery slope.
The other thing that it brings up too, Joe, and you alluded to it, and I just want to spit it out there since it's in my dome, is that the data that comes out for us as traders, investors, we want to know that the data that's coming out has integrity. And if you link it to someplace else that doesn't have the same value or wants to manipulate it, then the integrity of the data is in question at all times. Not that it isn't already, but it will be even more so. I mean, a prime example is like, I love to do this because I love to pick on China, but can you trust numbers that come out of a government like that? They want us to believe, for example, that they have that their demographics are what's the current demographic?
1.4 billion, I think. And then you have estimates. Actually, this is what I was going to bring up, the same stat because I just saw it. 1.4 billion in population, when other people actually say it's probably closer to like 500, 600 million.
Right, because somebody did the math and said, listen, women during that period of time, women would have had on average 4.5 to 5.5 kids per woman during that time frame to have that many people. So it's not that it's not me saying, oh, the number's bad. I'm saying the number's questionable. It doesn't have any integrity to it, and you don't want to become a system that doesn't have integrity in the numbers, right? And if you can't,
and we're already there too. To your point of what you're alluding to, we're already at a point now where people are already questioning some of the data.
Exactly, we're already there. So it's. I think it's a slippery slope. But we'll see what happens.
Agreed. Smiddy, any closing thoughts on that?
I mean, a lot of them, but a big one that just kind of comes to mind just on the numbers and like, hey, do we trust the data? I think OPEC is a funny example of that, right? They have a big impact on energy prices. And in reality, you look at Venezuela sitting on this massive, trove of oil, the biggest on the planet. Well, you do some reading and come to find out that those numbers were just made up under the Chavez regime. So how much oil does Venezuela have? No doubt a lot, but I think they were, estimating 300 billion barrels or something ridiculous. And if it's all made up, again, we're back to this fake data. If we're getting fake data from, trash in, trash out, like with anything, if you're putting garbage data in, you get garbage data out. But does anybody care? And I think we touched on this a little bit, but with all the craziness that goes on, we're kind of in this chaos theory environment. Everyone's just apathetic. You see the craziest shit happen and you move right along. And it's like, okay, next headline. Let me keep scrolling the feed. Oh, there's an explosion here. I'm so unfazed that should we have some sort of reaction? Should we care that Iran's having this kind of regime, altering situation? We should. I don't think that most Americans even know. I think they're so stuck in their own loop, right? With their head in the sand of whatever sandbox that's really important to them. I think that people are just desensitized, and we see it in the markets because we should be scared. But instead we're like, well, if I don't buy Tesla now, I'm going to be buying it at 500. Right. And there's just, who cares if there's a war, we're still going to buy Teslas. Right. I think that's a huge problem. something feels pretty broken in the markets. To me, what flags, and to kind of transition, Joe, is the metals market. Something, and when you guys are saying, well, where's the money? That's where it's all gone. They're going to rotate right into the metals, and it'll keep going. But that's saying something's broken. I don't think we should see gold and silver rallying like this, and it's the first time I'm really seeing it. So maybe that's why. A little bit of ignorance because I'm young, but it doesn't feel right.
There's at least a little bit of an explanation for the squeeze on silver, right?
Right.
There's at least the speculation is that China, again, having the largest physical stores of silver and pulling it out of the market, right?
Right. 100%.
That'll cause a run on the bank. You know what I mean?
Yeah, absolutely. And we covered some of this last week too, Ranch, but there's the industry that's, actually consuming silver that's not being replenished, right? It's not like gold where, you stick it in the vault or you make jewelry out of it. Like silver is one of those that we expend as almost like a waste material. It's kind of incredible in that sense, So I do agree though. You're 100% right. There is a reason behind it. And it doesn't make sense. Maybe it's all the years of the money printing and the kind of propped up, plunge protection team asset markets that now reality's catching up. And, we see it in some other physical markets when it comes to rare pieces, cars, watches, real estate, especially. So you're still seeing those markets, niche markets, still holding very, very strong. I don't know, man. I don't know.
I'm optimistic at heart, and I invest optimistically. It just, when I look around, I'm just looking at it and I'm like, something doesn't look right. Something like with all the global economic tension, the internal tension in the country, and the market just keeps ripping higher. Like I said, I'm not calling it top. I'm just looking at it and I'm like, I'm just surprised that we haven't seen some kind of a pullback. It seems like we would have at this point.
Right.
Yeah, that's
and that's
been
on the
my
back
struggle. Go ahead.
What's that?
Oh, I was just going to say that's on the back of, NATO coming out and saying, hey, if U.S. troops set foot in Greenland, we're going to, NATO's going to meet them head on. And the markets didn't care at all that the two, the European Union and the United States just basically had a moment on Sunday where we said we might actually have to fight over this piece of land. The biggest superpower in the world is now eating itself. And the market didn't flinch. That's fascinating in a way. And again, just desensitized. Do I think any of these leaders will pull the trigger? European Union? No, I don't think they would. Trump, we already know he will. That's the scarier part. We already know that there's a side that'll back down, and then we have a guy who won't. And that to me is the volatile. That's the volatility trigger in waiting.
So as we're sitting here, I just saw a headline, effective immediately. Any country doing business with the Islamic Republic of Iran will pay a tariff of 25% on any or all business being done with the U.S. So
I would kid you guys not. I was just looking at Iranian silk rugs like 20 minutes ago. So that's a bit of a bummer. I'm going to go ahead and get that order placed immediately.
Of course, you would be looking at that. Yeah, I mean, to kind of echo you guys' same sentiment and points, I've been, we've been talking about this pretty much all year, Smiddy, throughout most of the podcasts of when we've been looking at Jem Carson, and his, kind of analysis and thesis. And we didn't really get that whole peak to trough move that he was looking for, right? Of last year, that 35% pull. And he's kind of pivoted some of the stuff into 2026, but he's still, again, sounding the alarms for this year on some questionable, things that he's kind of been seeing in the markets. And again, if you look at all of the stuff that's kind of going on, to you guys' point, geopolitically, economically, all of it, it doesn't look great, which is why it's so surprising to see this constant bid in the equities and whatnot. And it's been tough, actually, because, Ron, you and I were talking about this. You kind of almost have to turn that off from now. Like, you can keep the skepticism and be prepared for any type of blowback from it, but it does not pay to go against the grain right now of what's kind of happening. And that's the hardest part, because I'm looking at everything not being like, okay, for 2026, like we have all these predictions of all these analysts and what they come out with. And I'm like, okay, I should, based off this, be getting long, getting a leap on the indexes, whatever it is. And I struggle to do it at this place. Like I struggle to do it at this spot, even if I can trade around it and do okay, which is what Ron, like you're really great at. It's just because of how much is like kind of like bubbled up. Like if and we talk about this with the gamma and all that, even if you just take out all of that type of stuff and you just look at the holistic picture. I saw this post from one of Jay's research pieces, and it was aggregate financial asset allocation across households, mutual funds, pension funds, and foreign investors. And we are at the highest it's ever been since they started tracking this. And this goes back to 1952. We're at the highest it's ever been, higher than the 2000.com crash, higher than the '08 financial crisis, higher than everything. Like, and that's just one piece. There's more and more of these types of charts getting higher and higher and higher. I think one was like PE ratios in where we're at in the S&P 500 is like the highest it's ever been. It's just crazy overvalued based off everything we've looked at. I think there's a Warren Buffett one. It's just kind of crazy, but it doesn't mean I could just sit here and be like, doomsday, I need to buy the shit out of puts because we're going to come crashing down. And that's what's been so difficult. So, I'm with you guys and echo the same sentiment. What I wanted to show now was these are the current predictions for 2026. And I like these because, one, if you look at what they did this year, these got revised like 6 times from every single place after we went down from all the tariff news and then went back up and then all of this. So it's just, I always find it interesting to kind of look at what analysts see. And in all honesty, outside of some of the outliers, it's 10% growth in the S&P. So for those that are just listening, I'm just showing like Oppenheimer, Deutsche Bank, Morgan Stanley, Wells Fargo, RBC, UBS, Tom Lee, all these different analysts and where they think S&P 500 ends next year in 2026. And the average is about 10%. And this was done in around Christmas time. So that move puts us at about an average of 7,500 on the S&P 500. Now, I know these are always tough. I love Oppenheimer sitting here at 8,100. And then you have Bank of America being at the bottom at 7,100, which prices in next to no growth. So it's just kind of wild to see how wide ranging this is. Like that's 1,000 handle difference between what Bank of America says and what Deutsche Bank, Morgan Stanley, and Oppenheimer say for this type of push. So I'm just curious, like, you look at this Smiddy, right? And you look at where Tom Lee is pricing all this and everything, and kind of where does your head go when you look at something like this?
I mean, kind of exactly what you alluded to. Where does the growth come from? I think right before this, I kind of polled and was like, hey, let's say we get an 8% year, and I'm looking at 70, mid, low 7,000s on SPX. I don't know where the growth comes from. And if like we were kind of, tinfoil hat theorizing earlier, if a lot of local spending and GDP comes from the fraud and grift and waste where these people re-injected into the economy, right, via consumption, and we cut all that out, while we may shore up the deficit a little bit, I think that that's going to show negative on a lot of company balance sheets. I don't think that looks good, and that's what I worry about is if the growth that we see in perpetuity is because of a bunch of shenanigans in the back end, then yeah, I think that we are in for some tougher times and not such easy growth. That's my thought. I still think that we're going to have an 8% year. I'm definitely not on the upper side of that. I think it's going to be, there's a lot of cash on the sidelines. I'm one of those guys. I have a lot to allocate and and I need a pullback and I'm not getting it, which is also a little frustrating because I can't chase here. So I'm having to really pick and choose. I don't know that other managers are going to be as choosy as I am necessarily. I think there's a lot of folks who will just kind of hold their nose and buy. So that might be what we get. There's a lot of people saying, you know what, I need to get my benchmark and I'm just going to go ahead and pull the trigger.
Yeah. Yeah, for sure. Ron, what do you think, when you're kind of looking at these? I know that you're not a big guy on like, let me put a price target at the end of the year, but just seeing what other big analysts have to price in, like where does your head kind of go with all of this?
I think it's, first of all, it's their job to do this. They've got to put something out and they've got to put some models together and get some numbers to get put out. I understand that. So the easiest thing to do is just look at it and pick something in the middle, right? if, and I don't know that there's any if thens, I share the same thought that Smiddy does about needing a pullback to throw money to work. And, I think I think Smiddy and I are in similar positions where going into mid 25, I kind of found myself going to cash and staying in cash, right? And then starting to redeploy, but not redeploy at a speed and I did fine last year, by the way, but not at a speed that would have maximized what I was trying to do. So I'm still sitting in a bunch of cash, right? Well,
Yep.
I mean, at least the good news is at least the cash is earning some interest, right? So where do I put it now? Like to Smitty's point, like things are so inflated that really I feel like the only thing I can do is look for some kind of a pullback and add to quality on that pullback. But I kind of have to decide what it's going to be. And I think, as Smitty was saying, where's the growth going to come from? I think the growth comes in areas that are not obvious or as easily explainable as they were last year. For example, software used to kind of be like a no-brainer, right? That's hit some snags, right? AI kind of hit some snags when people were like, listen, all that's happening is somebody said they created a bunch of money and now it's being passed around between Oracle and NVIDIA and Microsoft. And you know what I mean? So there's that sticking point. I think you see things like, I was talking about it today. There's a company, let me just pull this ticker up. It's the ticker is HII. They're a shipbuilder, right? Like that's something like that kind of an industry, which is Huntington Ingalls, right? They build ships for the Navy, right? Okay, well, you see growth in spots like that, where we might see growth in other areas. Like if you would see like a Caterpillar, but there's no, like a war in Ukraine might put a damper on their sales, right? Like I don't know where it's coming from. It's almost like you have to wait for things to push down and pop up, right? And then as you see them, say that I'm willing to look at that as an area for taking risk because I think it has potential.
Yeah. Yeah. And I echo the same sentiments as you guys. I'm in the same kind of boat. I think what you're really driving at, Ron, is important, and I'll get to that in a quick second. But just to kind of put a cap on like these estimates from everyone, what I pull from that, in my perspective, is just uncertainty. Right? Mm-hmm. When you got Oppenheimer putting you at 8,100 and Bank of America saying we're barely going to move this year, and then a bunch of people in between, I think you're right, Ron. It's basically you're taking a dart, throwing it in the middle, and saying this is probably a better place to bet. Right? It's just honestly what it is, but it just shows uncertainty. And I get that these analytics are not like the end all be all. Anything can happen. They can revise them. It doesn't really matter. It's just always interesting going into 2026 to see what analysts think. And when I look at this, I just go, okay, well, 10% is not a bad move for the year, but I go in the same boat. Where is it going to come from? And I think what I have kind of, established is I look at like where the markets are at, like what we need for the growth, what we need for some potential downturn. I think there's plenty of risk factors for us to get demolished in 2026. Like I'll put that out there now. There's so much tension geopolitically. There's so much uncertainty with the Fed that we just talked about. There's just so much data that has to come out that be honest, we're talking about whether or not we can believe it, or just whether the numbers are going to be great. Like I look at the economy in general, and this is just from how I feel the economy, right? Not just what we see in data, but like talking to friends, where people are at with credit card debt, seeing the job market and how I know people haven't found jobs in a year and a half and struggling. Like I look at all of that and I go, I don't think that this is even, people realize how bad it is for the average person. And I use that as a great proxy, at least for me, of, where we're at economically. So I look at all of those things as potential downside risks. And I think there's plenty. I can't time it. I'm not going to try to time it. That's the most difficult part, but it does change the way that I look at this upcoming year and how I want to position myself in trade. So what I'm doing is, and this is echoing what you're saying, Ron, right? And what you were kind of driving to, Smitty, is I plan on being selective. And plan on being selective in a way where I'm looking at what the rotation is or what they're coming into, and I'm not overstaying in my welcome. This isn't a year for me personally. This is just how I look at it trading wise, where I'm okay unless we get a pullback of some sorts of just throwing a dart, 10 darts on the indexes and all long, and I don't give a shit, right? Or throwing a dart on another big tech name and saying, I don't care, I'm buying that. I'm looking at this from a much lower time frame now, where I'm like, okay, there's a consumer cyclical rotation, okay, there's a defensive rotation, okay, they're coming back into quantum and the AI names, and trying to ride the wave of whatever the rotation game is.
Yep.
And worry a little bit less about what the index does, because they've done a really great job of just keeping us up and rotating across the board. Again, if the opportunity presents itself and things calm down and I look at the indexes and I'm like, wow, we have this potential to go up, or we get that dip, then sure, I'm going to be a player in it. I play the indexes every day, no matter what. I'm just not personally going to be looking at it from the longer term perspective of saying, okay, we're going to go here. I'm going to buy a call for this. I'm not going to do it. What I'd rather do, which is Ranch is your way of doing it, if I really wanted to be long in the indexes, is I'm going to buy some type of leap and trade around it. Right? That's the real play. And it's going to be an 80 delta, right, type thing.
Yep.
And I'm going to play it along that way. Right. So now we can have the fluctuation and I'm trading against it. But that's kind of what I look at, because again, there's potential for so much downside, but until that happens, they're just going to keep running it. And I think that the interesting themes for me that I'm paying attention to are the Fed, what that ends up happening, because that's all anyone's going to talk about now until we get a new Fed chair. What happens with inflation or stagflation, or any way that you want to kind of classify that, and what kind of economic data we get. And then will they be able to come back into tech and AI? I don't think you get a move to 8,100 without them piling right back into these tech names that drive the market. And I don't think that's a bold statement to say that. I think everyone would kind of agree. You need that participation across the board to drive us to 8,000. But they might be able to grind us up throughout the year 500 handles without getting aggressive in any name, right? And just rotating around. So that's kind of what I'm looking at right now.
You know what's interesting? What's interesting about tech, when you mention it, is if you look at what considers itself to be tech or how it's attached to it, right? So, for example, when the AI, I guess it was, you can think of it as like a gold rush, right? Like, remember when Oracle was just up every day and et cetera? Like, it's like, I look at the companies, and I've put together like a list of these companies tech-wise that relate to or are associated to AI in some way, shape, or form. Because I was mentioning software, right? Like, things are changing, right? So you had all of this money that was going into like Oracle, NVIDIA, Google, Microsoft, et cetera. And it kind of shifted, if you guys remember, like into semis, right? It was NVIDIA and Broadcom and AMD. And those all have like kind of taken a little bit of a pause. And now you're seeing all this money going into memory, like SanDisk and Micron and Western Dig, right? And then at the same time, you can't get away from the globe, the planet, can't get away from semiconductors just in general. It's as essential as oil and the air that you breathe. It's just in everything that we touch every single day. We're so reliant on it. And you've got names, now that are part of like that backbone, like KLA, Lam, ASML. Like, you can't make chips without those things, right? So to say that tech will stop, or that you're not going to be able to make money in tech, I don't think is accurate. It just doesn't, right now it's just not moving the way that it was and how we were used to it all moving together. It's like whack-a-mole, right? And you've got to identify the areas that are running at that particular moment in time. So for example, if you're still trying to trade NVIDIA, you've missed ASML, you've missed LRCX, and all you're doing is nailing your foot to the floor and running in a circle, right? Or if you were part of MSTR, right? Let's say you were coin, you wanted to be involved in coins, right? And you traded MSTR, and you're still trading it, and you're still trading it looking for the run up that it had before it sold off and is consolidating right now. There are a ton of traders struggling with that. You have to look around and find where the shift is and get involved in the shift when it's there, as opposed to continue to just try and fight. Well, it doesn't matter how much you love NVIDIA or how much you love AMD, right? If it's not there, it's not there. And will it come back? Probably. But until it does, you've got to look for the other areas that are having their moment if you want to participate.
Yeah, and that's a good point, because it echoes exactly what I was saying, of like, just find what's working and kind of play that rotation. And you actually nailed this theme last year. We weren't doing this type of podcast last year, but Ron's theme, and I don't even know if he remembers this, but me and him were talking at the beginning of last year about a lot of stuff for 2025, and his theme was, I want to find names that have to do with the semiconductor data center space and all of the AI names. He's like, and then you had a list. I remember this saying, okay, well, they can't do this without this name, right? And we weren't at a point where we felt like everything was overvalued back then, right? Either. And luckily there was that pullback with, Lib Day if you wanted to get in. But even if you didn't, we still passed all of those levels for the year, right? And I think that's really important. So when Ron says, like, I'm looking for good companies or valuable companies at a discount, right, or a great value, that's what he's saying. He's like, okay, these names rely on each other, or this is a good name. It is now trading at a discount. The technicals have improved. I'm willing to get in here. And I think that is my theme more than anything on how I plan on trading 2026 is just like that. Just what's the rotation? What are we doing? What's the discount I can get, if anything? And I'm going to keep trading that and keep my time frames much shorter. So
I think ultimately, Joe, and to tie into what you just said, was that there are a lot of other people, and this includes analysts and wealth managers, et cetera. There are a lot of other people who are way smarter when it comes to looking at the details of what's under the hood and having more bullet points, et cetera, to point at and say, this is what we like or what we think. And it's very different, because we do a combination of that. Plus, we're actually trying to not just asset allocate and throw money into a fund and then just not do anything. We're active, right? We're always actively looking for trades. And whether that's, to your point, what my strength is, which is longer term via leaps, swing or medium term. And now I've been working on the short end or the scalp end of the game as well. So I really am just focusing on trying to be a hybrid trader while taking this kind of a longer term view, and then trying to figure out, of those analysts and / wealth managers, who's just interested in promoting their own book, versus who's actually talking about what is realistic, if that makes sense. And then I've got to try and interpret that data and come up with my own thesis, and I actually have to try and put it to work, right?
Yep. Nope, makes complete sense to me, and I agree with you, right? And it's riding. The idea is you ride the wave. I mean, you could have done it this year too on some names. Like, there was names that I would have never touched ever.
Yep.
Right, like Bloom Energy, Nebius. Those are not names on my list. I just rode the wave, right? And they were great trades this year.
Yeah.
And I'm hoping to catch something of the same on the next kind of wave for this year. And if we don't, right, that's when you wait for the discount window and kind of go. So I'm with you. There are way smarter people that have to look under the hoods all day, every day, because that's what they get paid to do. Let's see which ones actually care about the consumer versus padding their own books, and not be stuck on a name, right? Like, people get stuck on Tesla, people get stuck on NVIDIA, which is a tough mindset to flip. Smid, any comments from your end?
I mean, I was just running through kind of the Mag 7 names, and it's very similar to what you just said, Joe, is if and when we get that rotation from small caps and checking out RSP as well, it looks like it's done, relatively well lately. That could be an interesting rotation. And like we were just saying, what is the catalyst that kind of pushes this market to all-time highs and gets more retail to chase? I think that would be it. I think a rotation. I go check out Microsoft, right? Microsoft, Apple, Netflix has been hammered. Some of these big names that a lot of people are in, a lot of, the bulk of the United States retirement owns all of these companies as well. And they're kind of lagging, right? So as we still see, I think it's hard for us. We've seen so many spec names run. And I wanted to bring up AXTI is a semiconductor substrate company that apparently has a very niche market. They're up 30% this week. So as I'm sitting here kind of complaining, like, oh, I got to be real careful and pick my spots and find the gems. It's like, they're out there. You really got to, you got to dig them up. So that's tough, though. I think that's a really hard game to play, especially if you have, bless you, Runch, if you got some, you can't necessarily go dump a big pile into AXTI. If you're a guy who needs, 10 million minimum of that, yeah, you're going to struggle a little bit. But that's what I'm looking at is we still have some big names that they could rotate back into that can drag us higher. The little guys, people will shuffle about, and then we'll want to pay attention to flow. I think that's going to be really important. If we get the rotation into the big guys again, we get broad indices back up, then I want to look for quality flow in some of the smaller guys that hopefully will take a breather. I'm trying to prep my brain for doing the old pinch your nose and buy, because at a certain point, I'm going to have to look at myself and talk to my client and say, hey, guy, we got to do something here. We're not going to, you're not going to be happy sitting in cash for half the year. So that's my thought process, moving forward. But yeah, that's what I kind of think is, majors could pull us up and keep us going.
Yeah, you need it. If Oppenheimer's going to hit his 8100, you're not doing without Nvidia fucking making an all-time high again this year,
right?
Or any of these other names. Like you need that participation, and we'll see what this is. So, I think that's a good place for us to kind of wrap up here. I think we've all given our thoughts as traders on what we're kind of looking for 2026, and it is definitely shaping up to be one for the ages, if you want to put it that way, with all the shit that's kind of going on. And I don't say that lightly. We have no idea what's going to happen, in the world, let alone in the markets. There's a lot of shit kind of going on right now, as you alluded to, Smiddy. So, from a trader's perspective, we just got to be nimble. We got to be prepared, and we got to take shots when they kind of welcome us to the batter's box. So, that's the way I know we're all kind of looking at it. And I appreciate you guys coming on here to share your opinions and thoughts.
Thanks for having us.